When we look at Europe, we always want to start with Germany being the largest economy in that region. And when you look at the business climate situation and expectations by sector, so when you look at manufacturing, it is now firmly in contraction. When you look at the different pieces, the service sector, the business climate, business expectations are now firmly in contraction, but the assessment of the business situation is still positive, and that makes sense. That's what we've been saying, is that the service side in most areas is still positive, but is now firmly going into contraction. And that's something that we're going to continue to see on the service front. Trade, the business climate is negative, the business expectations is negative, and you're seeing that trend lower. And as China continues to struggle, that's going to again pull that piece down, while construction still remains firmly in contraction with very little deviation from what we've seen so far. So then when you start looking at how this is weighing on people's views, well, consumer confidence is rolling over again in Germany, it's rolling over again in France, and it's something where it's rolling over faster or quicker than what even estimates are, because things are getting problematic fairly quickly when you look at these different regions. And the reason why is because real home prices in Germany are falling at their fastest pace on record. That's something going back to the 70s. Germany home price realized Eurozone contribution to the GDP deflator. When you look at it, it's labor costs. Labor continues to be expensive in a lot of these areas, and that's where, because of the cost of living, it's unlikely that you're going to see labor costs drop off. There's a lot of unions in there. A lot of the union contracts are tied to the inflation index. So PPI has slowed down, but again, the inflation side still remains sticky, even as some of the leading indicators for pieces of inflation remain problematic. And that's why we continue to see a lot of these pressure points. So the EASY composite PMI quarterly, when you look at EASY GDP, you continue to see, again, that pull to the downside with the Eurozone manufacturing PMI versus the developed market Europe earnings revisions ratio. And that's where we see the revisions coming down. And that's where you'll see that rollover in terms of just economic. We've already seen the economic growth, but it's a matter of when does it hit the companies, and you start to see a revision in, okay, well, we thought revenue was going to be $1 billion. It's likely going to be 750 million. And those are the types of pain points that we're going to see, on that range. Maybe it won't be as extreme, but that's where you start to see those pressure pieces really starting to weigh in. Private sector credit growth continuing to be negative. Now, people will look at this and say, well, that's why there's a problem. It's like, but let's look at the amount of liquidity that was dumped into the market from 2004 to 2008. And then you saw again from essentially 11 on up. And one of the things that we've seen is that it's going to take time to see that credit flow, because a lot of people have credit. A lot of them are exposed to adjusted rate mortgages. And that's going to take time to filter through the system and kind of purge through and get to more of a normalized stance. Germany and Italy, the 10-year government bond yields continue to pivot higher. Italy, again, outpacing where things are with Germany, which makes sense given, again, the level of debt to GDP ratios and the risk that exists in Italy versus some of these others, which is why we see some of those spreads blowing out, more so Italy, again, taking things a bit higher. Eurozone loans to households year on year came in at 1%, to businesses at 0.6%. And you can see we expect this to go negative as people and companies pull back on that borrowing, slowing that liquidity move, and again, confirming kind of what we've been saying on that inflationary stance. Eurozone composite PMI expected to be at 46.5, came in at 47.1. Eurozone composite future output at 54.1. So you're seeing, again, on the composite, you're kind of flatlining, and that's what we've been saying. It's not gonna continue to be dire and hit the 30s, but it's not going to bounce back to growth. And that's where we've been saying from the beginning, Europe is in a recession. They're here. It's now. But it's not going to be this massive, painful, hard landing. It's going to be this kind of bumping along the bottom based on a lot of the inputs that we've seen. German manufacturing PMI expected to be at 39.5, came in at 39.8. German manufacturing employment, 49.2. So here's, again, Germany is the growth engine. It's the largest economy in the world, and you have manufacturing below 40. You have services that is likely going to be below 50. So where are you going to get this growth? And now, while manufacturing kind of flatlines, moves a bit higher, services is going to come down, and that's the pressure point that we continue to see in general. Service PMI expected at 47.1, came in at 49.8. Incoming new business, though, came in at 43.8. So, yes, the services was slightly better, but the incoming new business is down. So that's where we see that movement, that next leg down. This is what we've been talking about on that service front, on the pressure front. French manufacturing PMI expected at 46.1, came in at 43.6. Employment steeply down to 45.5, the second largest economy in Europe. Again, moving down to the next level, which is why it's so frustrating when we've been sitting here saying, look, it's happening. Like there's not much else we can say when you look at where things are going. French service PMI expected at 46, came in at 43.9. All of this is moving in that direction, which is why we see the pressure in that European growth. So that's what we have for you here. You know, it was we didn't have much time to put too much together on the European front. I think this kind of paints the picture that we've been saying. And in the next segment, we're going to go deeper into Asia and starting off with China.